Good morning, everybody, and welcome to the Capital Allowance seminar, which is being run by Tim Palmer. I'm Toby Hermitage. I'm one of the tax partners here at Gravita. For those of you who may be encountering Gravita for the first time as a new name in the industry, we are a top 30 accounting firm. We have over 400 team members, and we offer a full range of accounting, audit, and tax services. We're very proud of the tax offering that we have. We have a number of people in here that are the envy of many firms around the country. We're also a member of DFK International, which is one of the largest networks of independent accounting firms across the world, which means that both us and our clients have access to a global coverage and reach. And these are all firms that are set up with similar mindsets to our own. And this means that you get the same level of and quality and personal service that you get from Gravita itself. We have a number of specialist expertises, including a focus on technology, regulated businesses, AIM companies, and property. But we do have clients across every conceivable industry and scale, from multi-billion-pound multinationals right down to startups that have yet to make their first sale. That's a little bit about Gravita. For those of you who don't know, Tim Palmer has been working with us for some time and likes to fill us in on all the technical things we might not have had time to look up for ourselves. So without further ado, I'm going to hand over to Tim and let him take you through some of the changes that have come to capital allowances, which, having been pretty static for a long time, are now in full swing and moving quite quickly at the moment. So over to you, Tim.
Thank you very much, Toby. Right. Good morning, everyone. Good morning to you. Welcome to my Capital Allowances webinar. Capital Allowances, where are we now? I'm Tim Palmer. I lecture all over the UK. I have been actually. On Monday and Tuesday, I was in Romsey near Southampton, Bournemouth, that area, for 2 days lecturing. And yesterday I was in Birmingham lecturing as well. So it's nice to be home from my office extension doing this lecture webinar this morning. As I say, I lecture all over the UK. I'm also a tax consultant with Gravita and have been for quite a long time now. And prior to that with ABG, which I really enjoy. And as Toby said, I think the tax team at Gravita is incredible. And I'm proud to be a member of it. And I think we cover everything, as Toby said, particularly say R&D. You know, we've done R&D seminars recently, and we've had a lot of response to that and work from that. So our tax team can help accountants and clients alike. I know there's a mixture of people watching this webinar this morning, you know, our own Gravita clients and accountants outside, and I'm going to aim to cater for all of you today. As well as that, as well as the lecturing and the Gravita work, I also write regular articles for all the tax magazines. The last one that I did was with Dion Laycock, our investigations one, which, as I go around the country, a lot of people have said to me, yeah, we saw that article, which is quite pleasing. So I write a lot of articles in conjunction with Gravita. Right, this lecture is going to finish from me around about, you know, we'll go for just under an hour this morning. Now, the key thing is you want the notes in front of you, okay? Gravita can sort you out if you haven't got the notes, but they're very good. So we should have really given you the notes, and you should have them in front of you now. And you want to mark them up with any extra comments I make, because even yesterday and at Romsey, people were saying things about capital allowances, and I thought, yeah, it's a good point. I'll bring that in when I do the Gravita Capital Allowances webinar. So there's going to be a lot of extra things this morning. I'm going to give my views. You might not agree with them, but you'd be foolish not to agree with them. So mark up the notes with my extra comments. All right. Okay. And if you've got any queries, or if you need any tax consultancy following this webinar, I think probably the best person to go through today is Toby, and that's his email. He'll put that up again at the very end, but that's the email address to contact us today through today's webinar. If you've got any queries on anything I'm saying or what Toby's saying at the very end, or if you need any consultancy advice, we'd be delighted to hear from you. So contact Toby on that email address there. Right, can we turn to the notes now, please? Page 2 of your notes and capital allowances, company expensing. Incredible. Absolutely. This is a wonderful time for a company to have a capital allowances claim, as Toby said. Absolutely amazing. It really has developed now. And from the 1st of April 2023, I'm going to follow the notes closely this morning. So you want them in front of you. Page 2. Companies now get 100% capital allowances, first year allowances on their plant and machinery. This is the new company expensing, the first year allowances. But you might want to write in straight away, companies get 2 things. They get the annual investment allowance on the million, which I think is a better claim, more on that in a minute. And obviously they get the company expensing. So there's 2 claims that a company can make really for their general plant and machinery: the annual investment allowance, the first 1 million at 100%, and then the company expensing, which is uncapped on brand new plant and machinery. Okay, and this is a huge tax saving. If you're a 25% paying company, corporate tax, people moan about 25%. They want to be dealing with it. When I first started my tax career off in the 1970s, the rate of corporate tax then was 52%. None of you will remember that. You're not as old as me. Even though like to think I'm quite fit. I go to the gym 3 times a week. But yeah, that was the rate, 52% in the 70s when I started my career off with Panelker Foster. The firm was Bull Baker Carnaby Deed, and they got taken over, and I worked for them in the 70s. 52% then, 25% now. But if you are an intermediate company and your profits are between 50 and 250, then expenditure on this capital allowances can save you 26.5%, which is pretty good. The super deduction has finished now. That was only very temporary, and that's come to an end. But I think, as I said earlier, the key thing to remember is that capital expenditure for a company on plant and machinery, the first year allowance, is uncapped, which is incredibly generous, completely uncapped, right? So the Chancellor's brought all this in, but the one thing you do have to remember is that individuals and partnerships do not get the company expensing, but they have a pretty good deal. If you're an individual or you're a partnership and you're doing capital allowances claim, you can claim the annual investment allowance, individuals or partnerships, and that gives you $1 million at 100%. And I think for the majority, a lot of clients, that will be enough for, sole traders and partnerships. Not all, obviously, but that's pretty good. 1 million at 100%. So individuals and partnerships don't get the company expensing, obviously, but they do get the annual investment allowance of 1 million at 100% for each year. But the key thing to remember, if you're a company and you want to claim this first year allowance, the expenditure has got to be on brand new and unused assets. Got to be brand new and unused assets. Okay, but can I say one thing? The annual investment allowance can be on second-hand plant and machinery, which is very useful. So this uncapped first-year allowance for companies, which is incredibly generous, you couldn't get more generous. Perhaps it's worth claiming the annual investment allowance on the second-hand stuff. More on that in a moment, because you won't get that for the company expensing. Company expensing has to be on brand new and unused assets. And you can do so many claims. I mean, on computers, IT equipment, plant and machinery, furnishings, vans, lorries, cabling. I mean, it's incredible. And you'll get this 100% first year allowance. But there are exclusions, right? And you can't claim, pretty obviously, the 100% company expensing first year allowance on second-hand items, and you can't claim them on integral features, the company expensing. Integral features, which have been quite involved with over the years, they're claims where perhaps you've got a hotel and the hotel puts in a lift. They put in air conditioning, lighting, heating, a water system. All of those things strictly go in the 6% pool, but can I say this? In reality, they don't. And when you've got integral features, there's nothing to stop you claiming the annual investment allowance 100% on the first million of integral features. I've been doing that for years. The legislation encourages you to do that. And I think now, if you are a big hotel and you know, perhaps you build a new hotel and you put in all these integral features and it does cost millions, perhaps you're part of a big hotel chain. What I would do is claim the first million annual investment allowance on the integral features. And then after that, what you could then do, because the government is so generous with these cap allowances, you could claim the 50% first year allowance. So integral features, which is quite a wide, broad area, it's very generous for you. You could claim the annual investment allowance on the first million, and then your expenditure on integral features in the year above the first million, you could claim the 50% first year allowance. Look at the extra example. This is not in the notes, but just look at the example. You might want to jot it down. A hotel company spends 3 million on integral features, including lifts, escalators, air conditioning, etc. Right, 3 million. What's the best cap allowances you can get on that 3 million? The first 1 million should be the annual investment allowance, and the remaining 2 million, you can claim the 50% first year allowance on. So, you know, you got to check with your software, and if the software doesn't do it in the best planning order, you might have to override the software to do that. Right. Can I, so much to cover this morning, can I just quickly move on? The Chancellor announced in his budget that he's going to introduce and extend the company expensing to leased assets. And when he said that, I thought, wow, that's quite generous. When will he do it? Answer, we don't know. The Chancellor has said in the budget that he's going to extend 100% company expensing to leased assets at a time that's suitable. I predict that won't be for another 3 or 4 years yet. I think it'll be quite a delay, but eventually it'll happen. Right, okay. So turn over to page 3. All of that is wonderful, but as you get older in life, you get as you get older, you think, where's the catch? That was my daughter Amy always used to have that expression when she was younger. I was also always saying Tottenham are wonderful, all these things, and she would always say to me, Dad, where's the catch? If she was studying this, and she could do, she would turn around and say, where's the catch to this company expensing? 100% cap allowances on new assets, no upper limit. Where's the catch, Dad? Where's the catch? We'll turn over to page 3. There is a catch. And the catch is that if you claim the company expensing, the 100% cap allowances uncapped on big sums, the moment you sell those items, you're going to get an immediate balancing charge. If you're a 25% company, 25% times the proceeds, and you can't shelter the balancing charge by putting the disposal proceeds in the general plant pool. So the thing you want to know to mark up the top of page 3, and we'll do the Harris example in a second that explains it. The thing you want to note is that you've got to keep a really accurate record of all this company expensing. And the moment you sell these assets, you're going to get a balancing charge of the proceeds that can't be sheltered. You can't put those proceeds in the general plant pool. All right. So that's the position. Okay, these are harsher tax rules. Look at Harris Limited. Harris incurs capital expenditure of $1 million. It's already used up its annual investment allowance. So they spend $1 million in the year to March 24, and they get 100% cap allowances on $1 million. They're very happy. A couple of years later, they sell those assets for 600,000. You're going to get a straight balancing charge, 600,000 sell proceeds at 25%. Those proceeds cannot go in the general plant pool. All right, so you've got to be a bit careful there. And can I put up an extra slide that you might want to consider? I think the planning for every company now generally should be claim the annual investment allowance first and the company expensing second. Why? You might want to note this slide, a little extra. Why? because if you claim the million first, a lot of companies won't have much more than a million, if that. With the annual investment allowance, and you then sell eventually that plant, the proceeds can go in the general plant pool and be sheltered by the tax written down value brought forward. So whenever I've done a joint lecture, I've been lecturing for the institute, joint stuff, I speak to other lecturers and they say, yeah, the planning should be claim the annual investment allowance first and then the company expensing second. I repeat, with the annual investment allowance, which you can get on everything, including second-hand stuff, you sell those items 2 years later. They go in the general plant pool, and the proceeds can be sheltered by the tax written down value brought forward, which they can't be if you claim company expensing. I'm not sure if your software is automatically going to do that for you. I doubt it. So you might have to override the software to do that planning. You'll have to wait and see. All right. Now, I used to work in industry in the 1980s, more on that later. I love working in industry. Why? There was no timesheets. You could wander down the corridor, chat to people for 20 minutes and not have to worry about charging your time. But when I worked in industry, they got me back because we had year ends that were horrific. We had to stay overnight in a hotel nearby to get through the tax on the year ends. And then as I progressed in industry, I dealt with warranties and indemnities. So that was even worse. Bring me back timesheets any day. But I'm really into deferred tax through my career in industry before I returned to the profession. I lecture on deferred tax. And I think companies now will have huge in their balance sheets deferred tax liabilities because they're getting all these 100% capital allowances uncapped and they won't get the depreciation so quick. And they're going to have a massive deferred tax liability in the future. And the other thing to remember is that these are big changes, but I do think perhaps the bigger companies will benefit more than the smaller ones. Now, that's what I think perhaps. In the 1980s, as I said, I worked in industry for a shipping group, huge shipping group, which was an incredible experience working there for a few years as I did. And we used to get 100% capital allowances on the ships. We called it free depreciation. And that created losses every year and group relief. So I can quite confidently predict, because I did a lecture to people in industry 2 weeks ago, and they all said we're going to have massive losses in our companies now because of the 100% capital allowances uncapped. And I said, well, what are you going to do? And they said, well, we're going to group relieve the losses if we're in a group. We're going to carry the losses forward. And can I remind you, go to the next page, go to page 4, that in 2017, which was quite a while ago now, they changed completely the trading losses regime for a company. And a company now can carry trading losses forward, created by the capital allowances. They can carry the trading losses forward against anything at all in the next accounting period, up to 5 million, and then 50% of the excess above 5 million for that period. Why don't we do a very quick example that will remind you? If you've got, look at the notes on page 4. Right, if you have got a company with 10 million loss in the year to April to December 2023, and they carry it forward to the next year, perhaps that 10 million loss has been created by capital allowances. And in the next year, they got investment income, trading income, total 11. How much can you carry the 10 forward against the 11? Right, I'm just going to look at the screen. You check my notes, and I'll do it off the top of my head, looking at the screen. Right, 10 million carried forward to 11. You can wipe out the first 5 million of the 11, and then 50% of the profits above 5 million. 11 minus 5 is 6. 50% of 6 is 3. I think you can wipe out 8 million of the 11 for that period. And you'd have to carry the 2 million left over forward to 2025. That is correct. And it's all in the notes and you can follow that through. So I do predict you know, from speaking to everybody in industry, from being in industry myself previously, that the big capital allowances regime is going to create a huge amount of excess company trading losses that will be group relieved or carried forward in the future. Right, now, when I go out and about on my travels, I speak to a lot of people, as I've done over the last 3 days, and Gravita helps all these people. We help clients, we help other accountants, we have a huge tax consultancy service. And many years ago, before I joined Gravita, I had to deal with a case involving landscaping. And this accountant said to me, if you turn over to page 5, he said, I've got a client, beautiful hotel, and they've got a wedding license. They've just received permission. They got the wedding license, and they can have weddings in the hotel or the gardens. And he said to me, I'm going to landscape the gardens and make them beautiful. And we're going to have the weddings in the gardens in the late spring, summer, you know, for 2 or 3 months of the year. 3 months, maybe, depending on the weather. I think the weather's pretty good. I've got a window by the side of me now, and it looks a lovely day today. Spring officially came in yesterday, I think. I think today is National Poets Day. Correct me if I'm wrong. Poems Day? Anyway, so landscaping. I wonder if he's got a wedding in his hotel today. Well, it was a company. The company's got the wedding. And they said to me, we're going to spend a fortune landscaping our wedding gardens in the hotel. Can we claim capital allowances tax relief on the landscaping? Well, if you go to the revenues manual, you will see that landscaping, according to the revenue correctly, is capital expenditure that doesn't qualify for capital allowances. And this hotel company were furious. They blame me. Everybody blames me. If they don't get the correct tax position, people blame me. I'm just the messenger. And they said, Tim, you've done some fantastic stuff in the past. Please, can we get the capital allowances? We deserve it. It's huge expenditure for our hotel in spending a fortune landscaping these gardens. And the revenue will get their money because when the gardens look better, we'll put it on video on our website. We'll have more weddings here, more income, more tax for the revenue. And I had a colleague who helped me. This was a long time previously. And we went through it and we looked at all the cases, and the tax law on capital allowances very much depends, is the item functional, performing a role? And we claimed the landscaping capital allowances, we claimed it, and the revenue queried it. We had to go meet the revenue. And we did a presentation, and this suited me right up my street because I lecture a lot. And I did the presentation saying that it was theme landscaping, performing a role, functional within the business. And we succeeded, and we got the very big landscaping claim allowable as capital allowances. And that's what a Gravita we can do for you. We got some, as Toby said, we've got some really good guys technically, and guys that are used to negotiating with HMRC, with other people, and we could help you with your claims. And it was very interesting. I'm going to tell you this. Yesterday, when I was lecturing in Birmingham, this man said to me that he had a landscaping issue, and the day before, another man said he had a landscaping issue, and perhaps I can focus on him. This delegate said to me that he had a landscaping claim that he wanted to do, and his firm of accountants acts for a nursing home. You might want to jot this down, a nursing home. And they said that the nursing home had to be very competitive because there's so many nursing homes in the area. And he said the gardens are not good enough, and we're going to have to landscape the gardens so that the people there can be, sometimes in their wheelchairs, can go out. We're going to have to make it more specialized for them, more attractive, so they want to go outside. and have these beautiful gardens in the nursing home. And he said, do you think we'd get tax relief for the landscaping of the gardens in the nursing home? And I said, well, I think it's quite similar to the landscaping for the hotel. I do think it's quite similar, functional, theme landscaping. I gave him my card, and hopefully in the next few days, we're going to get in touch and we're going to help him and assist him, which is what we could do for you. But I think he'll succeed there. But I do think when you do these claims, it's all down to how you present them. And if you have to meet the revenue or deal with it in correspondence, how you deal with that. And again, as I say, we could help you in that area. Right, so landscaping has to be really themed, functional, performing a major role in the trade of the business or company. Right, can we move on? Page 6, the structures and buildings allowance. Right, you know, I'm in a good mood today, even though my team Tottenham lost at the weekend. Why? Because they only have 2 defenders when they should have 4. But generally, I'm pretty happy. It's spring's in the air. But the moment I look at structures and buildings allowance, I don't get quite so happy. Why? Because the percentage, 3%, is too low. I remember dealing with industrial buildings allowances claims, and you could claim from memory a 75% initial allowance and then 4% straight line. So you used to get 79% in year 1 and then 4% for the remainder. What a difference. With the structures and buildings allowance, it's too low. I'm going to be honest with you. These are my opinion. And it's only 3% straight line, which takes you ages to get the capital allowances. But if you have a business that constructs a brand new commercial building or structure, then you get the SBAs. And it's 3% straight line, which is disappointing. But the one thing you do need to remember is that SBAs are given on commercial buildings or commercial structures. Yesterday, somebody said to me, can you tell me some of the SBA claims you've done on structures, commercial structures? If you've got a pen there off the top of my head, well, I actually jotted it down half an hour before I started this webinar. We've had successful SBA claims on structures, and I'll give you 6. A concrete car park. You know, and the previous accountant dealing with this had never even thought about claiming SBAs on it. We got 3% straight line. And the beauty is that obviously, if you eventually sell these things, then the purchaser will inherit the balance of the capital allowances, and you can negotiate to get a figure on that as a deferred tax asset. More on that in a minute. But the 6 that we've done, there's more, but perhaps 6. Concrete car park, commercial structure, tunnels, walls, tennis courts, roads, and bridges. I'll say those again. A concrete car park, tunnels, walls, tennis courts, roads, and bridges. We've got the SBAs on all of those successfully, and some huge figures as well. This is an area we very much specialize in. And can I be honest with you? I do think it's an area that a lot of accountants miss out on claims for, on the structure side of things particularly. So if you're creating any commercial building really used in your trade or commercial structures, you should be able to get the SBA. So 3% straight line, but remember, no relief is given under the SBA claim for planning permission, legal fees, or stamp duty. It's 3% straight line. All trades and professions of occasions will qualify, right? Now, the strange thing with this is that there's no balancing charges. And so if you were to construct a brand new hotel and you got 3% straight line for the first 3 years, you'd be getting 9% in total capital allowances. And then the remainder, 91%, of the unclaimed capital allowances go straight to the purchaser. He steps into your shoes. And I've always thought this was really unfair. So you just want to write in, and this is so common. I mean, you think of the number of commercial buildings that are constructed in the UK. I do wonder if the accountants are claiming the correct SBAs and dealing with it properly. I doubt it in every case. But you claim your SBAs, but you're only going to get 3% every year straight line, which is too low. But that's what the law says. But when you sell that office, that warehouse, that retail premises, wholesale premises, that factory, that betting shop, whatever it is, commercial building, the unclaimed capital allowances automatically pass over to the purchaser. So you constructed it, but you only get 3%, 9%, say, after 3 years. And the purchaser takes over all the unclaimed SBAs, which I think is really unfair. So quite a few years ago now, probably about 4 years ago, 5 years ago, I thought, I'm going to put a stop to this. And what I'm going to do is, when my next client that sells a commercial building, this was pretty much from the start really of SBA, so maybe a bit further in the past, I said to the client, we got to charge the purchaser for taking over the deferred taxed assets, the 91%. And the client said, well, what do you mean? And I said, well, I'll speak to your solicitor and we'll put in a clause in the contract that the purchaser has got to pay us, you, the client, for the 91% capital allowances on millions of pounds. I mean, the hotel was constructed for millions, cost millions. And I went to the solicitor, and the solicitor, quite unbelievably, had never done this before. And I said, well, I think we should do it. And we put it in the contract. The purchaser's solicitors looked at it all, and they said, we've never had to do this before. And I said, well, I think you should. We're charging you for the deferred tax asset for getting all these capital allowances. And I said, if you don't want to pay for this, the deal doesn't go ahead. And there was a lot of bartering, and we had to slightly compromise in the end, but we did it. And they did pay a big sum for inheriting the deferred tax asset, all those capital allowances. And you want to note this point, because I honestly think that many accountants advising their clients when they sell a building never cover this. And I think their clients are missing out. We cover this, Gravita covers this. But I think a lot of people miss out on getting higher consideration when they sell a commercial building, because they're not charging the purchaser for the deferred tax asset of the future capital allowances. So there's a lot of bartering that takes place, and we do it, and we get much higher consideration for our clients, and our clients are delighted. But I do think a lot of accountants miss out, or they haven't got the expertise that we've got to be able to do that, that situation. But, you know, you could refer to Toby or myself, and we could help you in that area. But it's common sense, really, and I think it's very important. And the other thing to remember is that you need to do the planning where to put the building, right? You need to think, should that building go inside a company or should it not? Yep. You might need a reorganization. We've done that many times for clients, and we can help you do that. So you do need to be very careful. Where should that building go? Where should it be positioned? Inside a company, outside a company, standalone. And you've got to look at the tax consequences, which can be massive in addressing that. Right, now the other thing to remember on structures and buildings allowances is that you can get SBAs. And the other thing to also consider, they may go up at one point. And if they go up, you know, the balance of your years will just be a higher rate. So it's always worth claiming and getting and doing a good SBA claim. You can get the structures and buildings allowance when you renovate an older building. And if you've got a pen there, you could mark up the bottom of page 6. This is something that I've done myself over the years. And I'll never forget, I went into a jeweler's in London, and I said to them, because I knew the owner, and I said to him, your window is dreadful. And I said, I bet you've had that since the 1960s when Bobby Moore was going up to receive the World Cup. And he said, yeah, I've had that window for a long, long time. And I said to him, well, you want to knock that window out? And he said it would cost a fortune. I said, well, you've got to attract more people coming into your jeweller's shop. And he said to me, do I get capital allowances, plant and machinery on the window? I said, no, you won't. But you can claim the structures and buildings allowance if you renovate an older building, and you're renovating an older building here. He did he knocked out the window, he put a new window in, and we claimed the SBAs, the revenue queried it, and we got it. And so you can get it when you renovate an older building, but it's not quite as easy as that. You're going to have to take advice and look at the legislation, look at the revenue commentary on this area. But we've done it. Two big claims that come to mind for me. We did it on that one, jeweler's window, knocking it out. We got it, renovating the building. And the second one was this restaurant wanted a spiral staircase to be put in, a massive, beautiful, very, very expensive. They knocked out the old one, which was falling apart, and we claimed SBAs on that, and we got that. But the one we failed on, and this was really inheriting a case, really. We didn't get the SBAs when they put in a false ceiling in a restaurant. You can't claim capital allowances on a false ceiling as plant. We took the case over, but we were always thinking that it wouldn't succeed because the revenue alleged that just simply putting in a false ceiling wasn't renovating the building. So you have to be careful in that area, and there's a lot to consider. Now, page 7 really of your notes is a planning page, and I think I've covered a lot of this already. But you do want to, when you have a client that sells a commercial building, you want the client and you want to negotiate with the purchaser, what are they going to give you for the SBAs they're going to inherit? And all of that there is on the top of page 7. And you need to do your planning, as I mentioned a few minutes ago, on where to put the building. Should it be in a company or not? You need to take advice on all of that, and we could help you with all of that. But there's one big, common, regular area that we do a lot, and that is when somebody constructs a hotel, a restaurant, whatever, what qualifies as plant and machinery? What can you get the 100% capital allowances on? I think it's a bit of an art, a science, and Toby will tell you because he's very involved with that, and he'll tell you this at the end. Gravita can really help in advising what's plant and machinery, what qualifies in this area. I mean, we advised a company who constructed a big hotel. This is on the bottom of page 7 of your notes. And there was so much expenditure on different things. They put in a health club. And we had to comment, did the sauna qualify? Did the swimming pool qualify? It did. There was a case on that, Cook versus Beach Stations Caravans. And we advised the hotel, and we did, I thought, when we finished the claim, I thought we did an incredible claim. And we got all of it accepted at a very high figure for capital allowances. We had to differentiate what was revenue expenditure, what was plant, what was part of the building. And that's a big feature that our team can help you with. But I'm going to slightly digress here. And occasionally, when we've assisted hotels, and these are big hotels, we've had to also consider the construction industry scheme, because the hotel will be a contractor because they spend a lot of money doing up their premises, millions each year, a deemed contractor. And the last one that I did was where the hotel put in a beautiful conservatory, and they put a lovely window in the conservatory. And they commented to me, and I said, well, a window is not plant. You won't be able to get tax relief on that. And they said, do we have any other tax issues? And I said, yeah, you will, because you're a deemed contractor and you're putting in the beautiful windows. And they said, yeah, but we're going to get the artistic exemption for that because the windows have got all these special designs on them. They're beautiful. And I said, you won't. You'll only get the construction industry artistic exemption if it's 100% artistic works with no building function, like building a statue. If you put in a window in a hotel that's beautiful with all the artistic works like a church window, it's lovely, but a window lets in light, has a building function, and you won't get the construction industry exemption. So the only reason I raise that point in my webinar today is that quite often big hotels and big businesses are contractors because they spend more than 3 million a year doing up their own premises, and they have to think of the construction industry scheme when they're doing their planning for the capital allowances as well. And quite often we have to deal with architects and surveyors, and architects always think we're outside the scope of CIS, but they're not. If an architect does the design for a lovely new hotel, they are outside. But if the architect signs a contract to manage the project, that's called to CIS. So I'm going to stop there on the CIS side of things, which is something that our firm Gravita really specializes in, and I specialize in. But you do need to consider sometimes all the other different areas, such as VAT, CIS, when you're doing what you think is pure capital allowances planning. Right, now just one final thing on the SBA before I go any further, and I think this is quite important. Go to page 8. You've got to remember that if you do sell a commercial building on which you claimed SBAs, there's no strict balancing charge, but the SBAs you've claimed will be added to the sale proceeds for capital gains purposes. So that point is the second paragraph on page 8 of your notes. And I think that's really, really important. So remember, you want to start that on the top of page 8. When you do sell the commercial building, you won't have a balancing charge as such, but you will have to add the SBAs to your sale proceeds, and that will increase the capital gain for capital gains purposes. All right, it's all there. As I say, if you've got any queries on anything I'm saying, we'll put our email address up again at the end, because sometimes companies and businesses spend big figures on these capital allowances, and you need advice to help you to get everything correct. Right, a simpler area, okay, capital allowances for cars. A bit of a simple area here, but on page 9, but I do feel that quite often people claim the wrong capital allowances on cars. This is the table on the top of page 9, and I'm going to go through it now with you, and you want to just perhaps mark up with any extra comments. Can I just reflect for a moment? You know, there's so many things in tax that you do need to consider. Capital allowances is a big issue. And I think it's good to reflect if you've been successful with your capital allowances claims. We were successful with that hotel, with the landscaping, and they put the wedding, they videoed it with the bride and groom's permission, and they put the wedding video on their website. And it's quite tearful, actually, when you go to it. In the background, they had the Carpenters singing the wedding song, "We've Only Just Begun." If you've never seen that or heard that, you should Google that. Anyway, right, getting back to the tax. Capital allowances for cars. If you buy a fully electric car, you can get 100% first-year allowances. If you buy a second-hand electric car, it goes in the main plant pool effectively, and you'll get 18%. If you buy other cars, such as hybrids, but low-emission hybrids, but they've got to be pretty low emission, you'll get 18% if the hybrid is 50 grams per kilo or less. If it's a bit more of a gas guzzler, not much more, but a bit more, you'll only get 6%. What we're finding is that a lot of companies now, businesses, buy these cars, and they're only now, because they changed the legislation on cars a couple of years ago, they're only getting 6% capital allowances. So it's not quite so generous now. Right, okay, moving on. When you buy a car, everybody seems to think, you know, when you do capital allowances claims, you've always got to think of extra things, the extra areas, the VAT. Can I turn to VAT for a moment? When you buy a car, if you're just going to use it purely for business and it's incapable of private use, you can claim the VAT back on the car. And our VAT department has been Gravita has been quite heavily involved in doing that over the last few years. I think, again, this sometimes is missed. The wedding the hotel that had the wedding, they bought a wedding car, and we got the VAT back on the wedding car because it was proved that they never, ever used the wedding car privately, and they couldn't. because it stayed at the hotel in the evenings when there wasn't a wedding. The keys were kept in the safe reception. It was incapable of private use. The directors and staff had to sign a statement. We can never use it privately. And we got the VAT back on the wedding car. So when you look at all of these, the good tax advisor will be there, and he will be able to say, right, yeah, okay, we've got the cap allowances, this is the VAT, this is the construction industry. And even if he immediately can't say that, he's got a team behind him, the good advisor, that can help him, and he can refer other things too, as we do. Right, okay. On the top end of the scale, I'll never forget last year, this man emails me after I've done a webinar, and he says, my company has just bought 3 Porsche Taycans, bottom of page 9. And he bought them, oh, sorry, the company bought them, £120,000 each. They got 100% cap allowances because look at the table, they are a brand new electric car. And he said we were just staggered that we only pay tax on 2% of the list price. Turn over to page 10. So, yeah, I mean, again, looking at beyond cap allowances for electric company cars are wonderful for employees and directors because they're only taxed on 2% of the list price. And fantastic tax position. And you should consider, I think, doing salary sacrifice as part of your planning in this area as well. But that's an add-on really to the cap allowances position. Right, okay. Now, tax never sleeps. And I always remember a few weeks ago now, I'm doing a lecture and I'm talking about double cab pickup trucks. And you've got to be on the ball because the revenue in February made an announcement that double cab pickups trucks for cap allowances and benefits are now will be cars in from July. They brought this announcement in, and I thought, oh, this is ridiculous. It's going to really increase the tax bill. It's going to reduce the cap allowances, and a lot of farmers and construction companies, with my encouragement, campaigned, and they said, no, this is crazy. So the revenue did a U-turn. Now, this is not in the notes, but you might just want to make a quick note of this towards the end of my talk. And basically, what the government has said now, and the revenues said now, is that amazingly, double cab pickups are vans, effectively, for benefit in kind purposes and cap allowances purposes. And can we just do a very quick reflection on that? If you're a company and you buy a double cab pickup truck now, you're going to get 100% cap allowances on your double cab pickup truck. And if you buy, for example, the Ford Ranger Wildtrak, which is quite expensive, 54,000, it's treated as a van for tax purposes, for benefit in kinds and cap allowances. Now, what the government was going to do is treat it as a car. So let's just very quickly compare the situation. It's a van, 100% cap allowances, and what the guy will be taxed on now is 3,960, plus if they put private fuel in, 757 private fuel. And if he's a 45% taxpayer, say, his tax is 2,000. If it was a car, it's not going to be a car. But if it was a car, he'd be taxed on the list price at 37%, which is what, 20,000, and the fuel would be a taxable benefit of just over 10,000. So his tax wouldn't be 2,000, it would be 13,000, which is 11,000 more. So what a difference. So a lot of companies now are being educated about this, and they're going out and buying lovely double cab pickup trucks. They're getting their 100% cap allowances, and instead of 13,000 tax per individual, they're paying 2, which is a huge tax saving. Right, we're almost at the end of my talk, so just the last couple of minutes from me, then I'll hand back to Toby. Easter. Easter is a time that I find a lot of people towards the end of the Easter break, and they have spare time on their hands, and they don't know what to do with that spare time. So I'm going to recommend that towards the end of Easter, perhaps you attempt, not before, the Roberts Capital Allowances case study. And that Capital Allowances case study is on page 11 of your notes, and there's some very interesting things in it. You know, I designed this case study based on our clients and their expenditure. For example, if you got a painting and you put a painting up in the hotel, would you get capital allowances on it? I think you would, because if you look at the model answer, you've got the case of Lord Howard of Helderskift that said a painting is plant. If you got a gazebo, would you get a gazebo as plant and machinery? I think you would. There was a case on that, Mrs. Andrew. So you want to go through that case study. That's a bit of a bonus for you in the appendix at the end of my notes. And maybe you want to attempt that and go through that at some stage in the future. There is a big model answer there as well, and you can go through that. And if you've got any queries, you could contact us. Right, okay, that is more or less it from me. I'm going to pass back to Toby now. Thank you very much, and back to you now, Toby.
Thank you, Tim. That was really helpful. I mean, I'll be honest, I've learned a few things there as well, particularly on the structure and buildings allowance, because for me, that's always been, what do we do with what's left after we've allocated anything out? And I think one of the key things that's come out of this, and it's one of the things that as a firm we're very focused on, is can we make an argument and then sustain it with HMRC? A lot of advisors will be very, very cautious, and they'll go, well, we might not win this argument, so let's not have it. Whereas if we can come up with a sustained and logical reason why, then let's claim it and let's have an argument with the revenue. As Tim and many of my other partners, we all like to have a bit of a rut with the revenue from time to time. It keeps us sharp. That said, I've got 3 case studies here. I'm just going to talk very briefly about, just to give you an example of the kind of things that we typically work with. Again, Tim's done a few other case studies. There is no hard and fast rules about where you can claim and where you can't. The answer is we have a think and we come up with a reason, and off we go. These are all things that I've worked on in the last 6 to 12 months. Funky office fit out. That was a client of mine who works in digital media. They built all sorts of magnificent things in their office. Sadly, no slides, but there was a table tennis table and pool tables, and they had their own bar. So it's a case of going through and, you know, in their initial accounts, they had leasehold improvements, £300,000. And we start from the perspective, what did you actually spend the money on? And at which point we start to build out a spec, and you've got quotes from the builders, the cost of the overruns that inevitably happen with all of these projects. When you're trying to do something genuinely interesting, nothing ever happens on budget. So and then it was allocating it out between all of the classes. Does it perform a function? Therefore, is it plant? Is it part of the building structure itself? Can we argue that there's, you know, there are other factors that allow it to, in the same way as the landscaping, does it perform a function? It may not necessarily be the function you expect for a digital media, but does it perform a key function within the business? So we go through and we analyze this all out, and we put together a nice little report, and, you know, we then include all those numbers in the tax comps, and you know, HMRC go, we don't really like this bit. And then we have a little bit of an exchange of correspondence and a couple of phone calls, and they went, you know what, actually, I think you're probably right. So again, by being that little bit more bullish in the way we go about things, that we've actually got some really positive results. The second case study is, you know, it's a client of mine. They basically bought a business about 3 years ago, decided that they really liked the business, but really hated the premises. So they bought a great big square of land and put an entirely new premises on it. And again, this is freehold additions, £4.5 million. And we sort of looked at that and went, you've got to have quotes, you've got to have specs. And they go, oh yeah, we've got clean rooms in here because we're doing high-tech manufacturing. You know, some of them, I mean, when we looked at the actual specs, it was like, why is this section of floor completely different to the rest of the building? They're like, oh yeah, because we're going to put a machine on it. Well, a floor's a floor. Surely you put a machine on it, it'd be fine. And they went, no, this machine weighs 12.5 tons. If we put it on a standard concrete floor, it will just crack the floor and sink into the fenlands. So then we had to go, okay, so the floor itself performs a function here. you have reinforced this because of the scale of the machinery. Therefore, it is part of installing the machine. Therefore, the floor itself, not the floors throughout the entire building, but all of the reinforced bits where they put very heavyweight plant on it fulfills a function, and it is part of the cost of the plant. Therefore, we've claimed all that. I've acted for a very high-end bar for a very long time. I'm a patron as well as an advisor to them. And a lot of what they do is they need to remain sharp. They need to remain, they are a little bit quirky. And the problem with being a little bit quirky, particularly in central London, is quirky becomes quite fashionable very quickly. So they are constantly updating the look, and they will have major overhauls on a fairly regular basis. And it's looking at what things perform a function. One of the blessings that we have is that there was a case many years ago that basically said if you were a restaurant or a hotel, things that add to ambience are effectively plant. So they've got weird things on the wall. They've got strange lighting, which the lighting would be fine, but some of the peripheral things that are attached to the lighting, well, it's not strictly a light, but it kind of joins up with the light fitting. Well, it adds to the ambience, so we're fine either way. And it's having that sort of confidence to go, okay, this is what it is. They built a new bar, and as part of that, they've got an oyster chiller built into the bar, and that had to be custom manufactured and cost a fortune. I don't particularly like oysters, so I think it was a complete waste of money. But apparently they've been doing a roaring trade in oysters ever since they brought this in, because it's one of those, because it's built into the bar and naturally cooled, people can see them and go, oh, I wouldn't mind a couple of those. And off you go. Suddenly they're generating revenue because out of sight, out of mind. Well, let's put it right under people's noses. We have done some weird and wonderfuls over the years. We've also done some pretty standard office fit outs, and it's amazing how much more there is to claim than you think there is. And a lot of it these days comes down to just the strength of record keeping. One of the things that I do with all of my clients, when they say, we're planning on doing, what are you planning on doing? What information are you going to need from those that are going to help you do it? So for a lot of the clients, that involves, getting a detailed spec out of the builder. Some things will qualify for capital allowances, some things don't. There was always the weird one that struck me is a door doesn't qualify, but the handles and hinges do. Well, if I'm going to have an argument with the fitter, I'm going to say, you know what? If you knock 10 quid off the door, I won't ask for a discount on the handles. And that actually saves you tax as well as being, a fun argument to have with every builder who goes, I don't care, it's just a door handle, and it all comes in one pack. So it's having that willingness to explore the potential. And again, if there are no records, I had a client some years ago, they bought a building, and the invoice basically said one building, £8 million. And there was absolutely nothing to support it. And this is where we actually reach out to, a capital allowance firm that we're friendly with who have actual surveying skills. They can go into the building and go, you know what, you spent 8 million quid. We reckon 3 million quid of that is sort of lifts and aircon and all of this other stuff, and break it down that way. So whilst record keeping is great if you're going to plan to do something in the future, there are also avenues to explore if you've already done it and you just don't have that kind of detail available. We can help out on both fronts. So that's kind of a little whistle-stop tour of what's changed in capital allowances. We also have a selection of other webinars coming up, not all of which are being done by Tim. So if you want a different face, there'll be a couple of opportunities. But if you like Tim, as we all do, then we'll no doubt be back for some other things in the next few months. Coming up first, on the 11th of April, we've got Michaela Lamb, who is one of my favourite partners, and she'll be talking about inheritance tax. Then we'll have, in May, Tim will be back to talk about entertainers, artists, and social media influencers. I may be old, you see, because I remember when this used to be the taxation of artists and entertainers and sports people, but apparently there are now more social media influencers than sports people.
You can't overlook them.
I've been desperately trying, but my daughter brings them to my attention all of the time. And then we're going to come back in June to talk about company tax computations and some of the mechanical issues that sit around that, and ways in which we can spearhead a more more formidable approach to HMRC and how to get the best out of what people assume that there is only one right way to do a tax computation. That's not strictly true. There are many ways to do them right, and it's just about having that degree of lateral thought. In July, we're having an alphabet soup, apparently. For those of you who haven't spotted these before, that's a management buyout, a management buy-in, or an employee ownership trust. All of these things are used as a succession tool and as a potential for a restructure, exit of shareholders as they would come up to retirement, or possibly just diversifying the shareholder base. Tom and Richard, who are both partners of mine, Tom will be covering the tax side of it, and I guess Richard will be talking more about the accounting for it as well. So that will be a really interesting one as well. Because at the moment, employee ownership trusts are a big feature. It's an area we're doing a lot of work in. Certainly, I've been doing MBOs and MBIs for the last 20 years. EOT is kind of the third prong, and there are a number of upsides to it against the other two routes, but there's also one or two sort of pitfalls that you need to be carefully managed. As always, we'd love to hear your feedback. What did we talk about too much? What did we talk about enough? Was Toby too loud? And did he just blend into the background because he chose the wrong jumper this morning and was now a talking head? If you have any questions, if you have any things you need advice on, if you want to just sort of drop us a line and let us know what you thought, then please do get in touch with me. Again, I'm Toby Hermitage. I am a tax partner, and my email address is tobyhermitage@gravita.com. So if you have anything more, then please do reach out. And thank you very much for your time. We really appreciate it. Have a good day.
Thank you. Bye-bye.